A small coastal nation you may not have heard of just reached the top of the 2025 Global Happiness Index. With a population of 300,000, they achieved this by shifting their focus away from traditional economic measures like GDP and instead tracking something called net national happiness. Their approach includes providing free healthcare and education, capping executive pay, and investing public funds into community projects. Businesses must follow strict environmental and social standards, reflecting a broader definition of national success. This model stands in contrast to the dominant systems shaping the global economy today. As we look at how other countries are faring in 2025, it raises questions about the strengths and limits of capitalism. The limits of capitalism in 2025. Across major economies, new data in 2025 highlights the mounting pressures facing traditional capitalist systems. According to the latest World Inequality Report, the top 1% of earners now control 45% of global wealth, marking the highest concentration since records began. This trend is not confined to developing countries. Even in the United States and United Kingdom, middle-class wages have stagnated, failing to keep up with rising costs for essentials like housing and healthcare for several years in a row. Inflation remains a persistent concern. The Global Monetary Fund's 2025 analysis shows that price increases, particularly for food and energy, have become a defining feature of the economic landscape. In the United States, annual inflation has hovered around 3% according to USA Facts, while other G20 nations report similar pressures. Central banks have responded by adjusting interest rates, but these interventions have not delivered the same results seen in previous decades. For example, Japan continues to face low inflation. Statista data puts it between 1.5% and 3.6%, despite ongoing monetary stimulus. The tools that once stabilized markets now appear less effective, and the cost of living continues to outpace wage growth for many households. Productivity gains offer another window into the system's limitations. OECD data shows that since 2023, robotics and artificial intelligence have boosted manufacturing output by 17% worldwide. However, these advances have not translated into higher wages for workers. In fact, the OECD reports that worker compensation as a share of GDP has fallen to historic lows in several industrialized countries. This disconnect between rising productivity and stagnant wages points to deeper structural issues in how economic gains are distributed under modern capitalism. Labor markets are also shifting in ways that expose vulnerabilities. While official employment rates remain high, a significant share of workers now rely on short-term contracts or freelance work, often without benefits or job security. This shift away from traditional, stable employment has led to renewed debates about the adequacy of existing economic safety nets and the need for policy reforms to protect workers in a changing economy. The decline in union membership across Europe, as noted in the European Union's 2025 labor survey, closely tracks with wage stagnation, suggesting that collective bargaining power remains a key factor in wage growth. Housing affordability has become a widespread concern, particularly in large urban centers. In the United States, Statista reports that housing costs have outpaced wage growth for several years, with inflation in the sector contributing to increased financial strain for many families. Efforts to increase the supply of market-rate housing have not meaningfully improved affordability, according to urban policy researchers, leaving many households struggling to keep up with rising rents and mortgage payments. Market concentration further compounds these challenges. Brookings research finds that a growing number of industries now operate as oligopolies, where a handful of firms dominate market share and are able to set prices with little competition. This consolidation leads to higher profit margins and reduced consumer choice, eroding purchasing power and making it more difficult for smaller businesses to compete. Environmental pressures add yet another dimension to the conversation. The 2025 Climate Accountability Index finds that private sector investment in decarbonization remains insufficient, with only a small fraction of major companies on track to meet global emissions targets. Market-based solutions such as carbon trading have not produced the scale of change needed, fueling calls for economic models that prioritize sustainability alongside growth. Financial markets, meanwhile, remain volatile. Central bank policies designed to stabilize economies have often inflated asset prices, disproportionately benefiting the wealthiest households. Federal Reserve data indicates that the top 10% of wealth holders capture the vast majority of stock market gains, deepening existing inequalities. Taken together, these patterns, rising wealth concentration, persistent inflation, wage stagnation, unstable labor conditions, unaffordable housing, market consolidation, environmental stress, and unequal financial gains, underscore the complex challenges facing capitalism in 2025. Policymakers and citizens alike are searching for alternatives that might address these shortcomings. The next step is to examine how some countries have responded by experimenting with new approaches, seeking to balance economic security with broader measures of well-being. Universal basic income, success or failure. Universal basic income, or UBI, has become one of the most closely watched policy experiments of the past decade. As economic pressures mount and traditional safety nets struggle to keep pace, governments and researchers have looked to UBI as a possible solution for providing a baseline of security in uncertain times. By 2025, a growing number of countries have launched UBI pilots or permanent programs, but the outcomes remain mixed and heavily dependent on local context and program design. Finland's trial remains one of the most well-documented examples. Over a 2-year period, a randomly selected group of unemployed citizens received monthly payments with no strings attached. The results, analyzed by independent researchers, reveal a nuanced picture. Contrary to early concerns, the work participation rate among recipients did not decline. In fact, some participants reported improved well-being and a greater sense of security, which allowed them to pursue new job opportunities or further education. Mental health outcomes also improved, with participants citing reduced stress and anxiety. However, the overall employment effect was modest, and the program did not dramatically change labor market dynamics. Researchers concluded that while UBI can enhance individual well-being, it is not a cure-all for unemployment or structural economic issues. Other UBI trials have highlighted the challenges of scaling such programs. Some countries have faced concerns about inflation when large-scale cash payments increased demand for goods and services. These inflationary pressures tended to be more pronounced in regions where supply could not adjust quickly enough, raising questions about the macroeconomic impacts of universal cash transfers. In some cases, policymakers have responded by designing targeted or regionally limited programs rather than nationwide rollouts, aiming to contain costs and minimize unintended side effects. The way UBI interacts with existing welfare systems has also shaped its results. In places where UBI supplements rather than replaces traditional benefits, recipients have reported more consistent improvements in quality of life. However, when UBI is used as a substitute for established social supports, the effects are less predictable. For instance, some recipients have used the payments to invest in education or small businesses, while others have struggled without the additional guidance or services provided by traditional welfare programs. This variation underscores the importance of careful policy design and ongoing evaluation. Cultural factors and public expectations play a significant role as well. In some societies, the idea of unconditional payments has met resistance, with debates focusing on fairness, work incentives, and the perceived value of social contribution. Where public trust in government and social institutions is high, UBI programs have tended to find greater acceptance and stability. In contrast, regions with polarized political climates or weak administrative capacity have struggled to implement and sustain these initiatives. Across all these trials, one consistent finding emerges. The effectiveness of UBI depends less on the basic concept and more on the details of implementation. The size of the payment, the method of distribution, the relationship to other social policies, and the surrounding economic environment all influence the outcomes. There is no universal formula that guarantees success, and what works in one context may not translate elsewhere. As the debate continues, policymakers and business leaders are increasingly looking at broader frameworks for economic and social progress. New approaches are emerging that seek to measure success beyond simple financial metrics, reflecting a shift in how societies define prosperity and responsibility. Stakeholder capitalism's rise. In recent years, stakeholder capitalism has gained traction as an alternative to shareholder-first models, with large corporations adopting frameworks that account for the interests of employees, suppliers, communities, and the environment. By 2025, the approach has moved beyond rhetoric, with a growing, though still uneven, adoption among major firms. More companies now publish annual reports that include both financial and social impact metrics, reflecting mounting pressure from investors, regulators, and consumers. While the exact degree of adoption varies, it is clear that stakeholder principles are no longer confined to the margins of corporate governance. Some multinationals have begun tying executive compensation to environmental, social, and governance (ESG) targets alongside traditional financial goals. Companies such as Unilever and Salesforce have publicized their efforts to integrate these metrics into decision-making, citing early benefits in sustainability and brand reputation. For example, Unilever has reported reductions in plastic use and waste, while Salesforce tracks workforce diversity and community investment in tandem with revenue growth. These changes are often highlighted in sustainability reports and investor communications, signaling a shift in what companies consider core performance indicators. Despite these developments, the impact on worker conditions has been mixed. There are documented cases of companies raising minimum wages and expanding benefits, such as paid parental leave, in response to stakeholder commitments. However, independent reviews suggest that turnover rates and promotion disparities persist, and unionization efforts remain active even at firms with strong ESG profiles. While some improvements are evident, particularly in areas like parental leave and workplace flexibility, stakeholder capitalism has not fundamentally altered the underlying power dynamics or addressed all concerns about equity in the workplace. Supply chain practices under stakeholder models show more consistent progress. Several case studies document modest but real gains in supplier working conditions, driven by sustainability programs that require ethical sourcing and regular audits. Companies have reported higher productivity and lower turnover among suppliers participating in these initiatives, challenging the narrative that ethical sourcing is incompatible with competitiveness. Although initial costs can rise, these often level out as sustainable practices become standard. Still, the extent of these improvements varies widely by sector and geography. Corporate social responsibility, CSR, spending has also increased, with firms investing more in community programs and philanthropic initiatives. While the scale of these efforts remains small relative to overall profits, there is evidence that targeted investments in education, workforce development, and local business support can generate positive economic impacts. Analysts, however, caution that these programs are often limited in scope and may not address deeper structural issues. Environmental commitments are one area where stakeholder capitalism has produced more measurable results. Leading companies have achieved significant reductions in carbon emissions and waste through investments in renewable energy and circular economy initiatives. For example, some have achieved carbon neutrality or even carbon negativity, citing operational savings over time as a result of these changes. However, these achievements often come with upfront costs and require sustained commitment to maintain progress. Financial performance among stakeholder-focused firms has generally remained stable, though not exceptional. Shareholder returns in some cases have tracked slightly below industry benchmarks since the adoption of stakeholder models. Analysts attribute this to increased operating costs from sustainability investments rather than revenue declines. Over time, efficiency gains and reputational benefits have helped offset some of these costs, suggesting that responsible business practices do not necessarily undermine competitiveness. Despite public commitments to stakeholder values, many companies continue to face inconsistencies between their ESG stances and their political activities. Public disclosures reveal that some firms support trade groups or candidates whose policies may conflict with stated social or environmental goals. This ongoing tension highlights the challenges of aligning corporate influence with stakeholder priorities, especially in policy arenas that affect labor and environmental standards. Employee sentiment toward stakeholder initiatives is cautiously optimistic. Surveys show that a majority of workers at leading firms approve of these policies, noting improvements in workplace conditions and a greater sense of purpose. However, a significant portion remains skeptical about whether these changes meaningfully shift power or decision-making within organizations. External analyses echo this view, finding that stakeholder capitalism has produced incremental gains, but has not overhauled traditional governance structures. Investor opinion remains divided. ESG-focused funds now control a greater share of equity in major firms, and traditional institutional investors are increasingly willing to consider stakeholder metrics as indicators of long-term resilience. Short-term investors, however, continue to challenge initiatives they see as diluting shareholder value, though their influence appears to be waning. Consumer response to stakeholder capitalism has been strongest among younger demographics, with brand loyalty and market share rising for companies perceived as purpose-driven. However, price sensitivity and mixed adoption rates among older consumers limit the broader impact on market dynamics. Independent assessments conclude that stakeholder capitalism has resulted in real but incremental change. Firms recognized for strong stakeholder commitments tend to outperform peers on social and environmental measures while maintaining competitive financial results. Still, gaps remain, especially in areas like political advocacy and global supply chains, where traditional business practices prove resistant to reform. As stakeholder capitalism continues to evolve, questions remain about its ability to scale and deliver sustained improvements across diverse markets. The search for models that combine economic prosperity with social equity and environmental responsibility continues to shape debates about the future of capitalism. The Nordic model in 2025. Among the most closely examined economic systems in 2025, the Nordic model stands out for its combination of high living standards, social cohesion, and strong public institutions. Countries like Sweden, Norway, Denmark, and Finland consistently appear near the top of global rankings for both economic output and social mobility. Their approach is defined by a comprehensive welfare state, progressive taxation, and a commitment to reducing inequality, all within the framework of a market economy. Central to the Nordic model is a tax system that funds extensive public services. Taxes account for a significant share of GDP, supporting universal healthcare, tuition-free higher education, and robust parental leave. These policies underpin a high level of social protection and have been linked by the OECD to better work-life balance and overall living standards compared to many other advanced economies. Citizens benefit from reliable access to health and education, while parents receive support that allows for greater participation in the workforce. Income and wealth inequality in the Nordic region remain markedly lower than the global average. While the world's wealthiest 10% control nearly half of all wealth, and the top 1% in countries like the United States hold over 70%, Nordic countries distribute resources more broadly. This is largely due to progressive income taxes and strong redistributive policies. The result is a society where the bottom half of the population holds a substantially larger share of wealth than in most other developed nations. This economic equality also correlates with low crime rates and high levels of public trust, as noted in recent peace and welfare indices. Despite these strengths, the model is not without challenges. Demographic change has put pressure on public pension systems. The ratio of working-age citizens to retirees has declined steadily, raising concerns about the sustainability of pay-as-you-go pension schemes. In response, governments have incrementally raised retirement ages and introduced means testing for higher earners. These adjustments help maintain fiscal stability, but have sparked debate about whether the original universalism of the model is being eroded. The Nordic labor market is shaped by strong unions and collective bargaining. Worker representation on corporate boards is a well-established feature, giving employees a formal voice in company decisions. This structure has moderated executive pay growth and contributed to a sense of shared responsibility within organizations. At the same time, Nordic companies remain competitive internationally, with profitability and productivity metrics comparable to or exceeding those elsewhere in Europe. Automation and technological change have brought mixed results. In manufacturing, union agreements have slowed job losses relative to global averages, but the service sector, where unions are less influential, has seen faster adoption of labor-saving technology. Governments have responded with active labor market policies, funding retraining programs for displaced workers. However, participation rates in these programs have declined as skill requirements shift more rapidly than educational systems can adapt. Housing affordability has become a growing concern, especially in major cities. Even after policy interventions, average housing costs now account for about 40% of median income in urban areas. Market forces continue to drive prices higher, and while homeownership rates remain high, younger households face increasing barriers to entry. Efforts to stabilize the market through stricter lending standards have had only limited effect. On the environmental front, the Nordic countries continue to lead in renewable energy adoption and carbon reduction, with some of the world's highest carbon taxes and a strong focus on infrastructure investment. These nations have achieved a significant share of their energy mix from renewables. This policy environment has supported the growth of clean technology sectors, though energy-intensive industries sometimes struggle to compete with lower-cost producers abroad. Education remains a cornerstone of the model. Free university access and student stipends have produced high tertiary completion rates, supplying the labor market with a skilled workforce. However, recent years have seen a decline in international student applications, raising questions about the region's ability to attract global talent as migration patterns shift. Integration of immigrants continues to be a focus. Employment rates for second-generation immigrants have improved, though wage gaps persist. Targeted job placement and training programs have helped reduce unemployment, but underemployment remains an issue for many newcomers. External pressures, including shifts in global trade policy and rising protectionism among major trading partners, present new risks for these export-oriented economies. Nordic governments have responded by seeking closer cooperation within the European Union, aiming to secure market access and buffer against external shocks. Digital infrastructure also receives ongoing investment, with widespread high-speed internet coverage enabling remote work and digital services. Nonetheless, rural areas sometimes lag behind urban centers, highlighting the need for continued upgrades. The Nordic model's ability to navigate these evolving challenges will shape its future role as a reference point for other countries. As economic systems around the world adapt to new realities, the Nordic experience offers a case study in balancing market efficiency with social protection, though not without its own set of trade-offs and pressures. China's hybrid approach. China's economic system in 2025 stands apart for its hybrid approach, blending state direction with market mechanisms in a way that does not fit neatly into conventional models. The country's growth remains robust, with the International Monetary Fund projecting GDP to rise by 4.6% in 2025, outpacing most major economies. This resilience is rooted in a strategy where the state guides investment in strategic sectors, while allowing private enterprise to flourish in less sensitive industries. The National Development and Reform Commission continues to oversee 5-year plans, but the focus has shifted from sheer output to more nuanced measures of quality growth, such as technological advancement and environmental sustainability. State-led sectors remain central to China's economic architecture. State-owned enterprises continue to dominate areas like energy, telecommunications, and heavy industry, benefiting from preferential access to credit and policy support. These firms play a stabilizing role, especially during periods of economic uncertainty, but often face criticism for lagging behind private companies in terms of efficiency and innovation. Private businesses, particularly in technology and consumer services, have been subject to tighter regulatory oversight in recent years. Authorities have introduced stricter data security requirements, mandating that major digital platforms undergo government reviews before pursuing certain business activities, especially those involving large sets of user data. This increased scrutiny reflects broader concerns about digital surveillance, data sovereignty, and the role of technology firms in society. While these measures have curbed some of the sector's earlier rapid expansion, they also aim to address risks associated with unchecked growth and data privacy. The property market illustrates the government's careful management of systemic risk. Following high-profile defaults and market turbulence, regulators have provided selective support to stabilize the sector, intervening to prevent broader contagion without fully bailing out troubled firms. Housing prices have stabilized after a period of decline, and the state continues to monitor the sector closely to avoid the buildup of excess leverage. China's manufacturing sector remains a global powerhouse, accounting for a substantial share of worldwide output. Strategic industries such as electric vehicles and semiconductors benefit from targeted tax incentives and policy support, which have helped domestic firms gain market share. The Made in China 2025 initiative continues to drive efforts towards greater self-sufficiency in advanced manufacturing technologies. At the same time, China has increased its imports of high-end equipment from Europe and Japan to upgrade its industrial base. The financial system is tightly controlled, with capital flows and market activity subject to regulatory oversight. The government has piloted the digital yuan, one of the world's most advanced central bank digital currencies, as part of broader experiments with programmable money. These initiatives are intended to modernize payment systems and enhance the state's ability to monitor and manage financial activity. Stock markets in Shanghai and Shenzhen remain active, though retail investors dominate trading volumes and capital controls limit outbound investment. China's trade position remains strong, with a persistent surplus and growing use of the renminbi in international settlements. The Belt and Road Initiative continues to expand, funding infrastructure projects across Asia, Africa, and Europe. Despite ongoing geopolitical tensions and export controls from Western countries, China has maintained steady export growth and deepened trade relationships with a diverse set of partners. Innovation remains a priority, with annual R&D spending approaching 2.6% of GDP. The government channels significant funding to priority sectors such as artificial intelligence and quantum computing, often through state laboratories and university collaborations. While the country leads the world in patent filings, the quality and global impact of its research remain areas for further improvement. China's dual circulation strategy aims to rebalance growth by boosting domestic consumption alongside exports. Policies have encouraged household spending and expanded access to consumer credit, though the share of consumption in GDP remains lower than in advanced Western economies. Regional development programs continue to target income disparities between coastal and inland provinces, using infrastructure investment and vocational training to promote more balanced growth. Energy policy highlights the challenges of rapid development. China leads the world in solar power installations and renewable energy investment, but coal remains a significant part of the energy mix as the government prioritizes energy security. The national carbon trading system covers major emitters, but low permit prices have limited its effectiveness in reducing overall emissions. As China refines its hybrid model, the government faces persistent questions about how to encourage genuine innovation while maintaining political and financial control. The next stage of economic development will likely hinge on how these tensions are managed, as new digital currency and financial instruments, the rapid rise of central bank digital currencies, or CBDCs, is reshaping the global financial system in ways few could have predicted just a decade ago. By 2025, 15 countries have launched some form of CBDC, each with its own approach to design, privacy, and policy goals. The motivations for adopting digital currencies vary, but common themes include improving payment efficiency, increasing financial inclusion, and granting central banks new tools for managing the economy. In practice, the results have been mixed. Some nations, especially in the Caribbean, have piloted CBDCs as a way to reach people without access to traditional banking, often with partial success. Offline functionality has helped maintain payments during infrastructure disruptions, but technical limitations and uneven adoption remain hurdles. In rural areas and among older populations, uptake lags behind urban centers, and digital literacy continues to shape who benefits most from these new systems. China's digital yuan is the largest and most closely watched project to date. Its rollout has highlighted both the efficiency gains and the surveillance concerns associated with state-backed digital money. The system allows for real-time transaction monitoring, which authorities argue is essential for preventing crime and ensuring the smooth delivery of stimulus payments. However, these same features have sparked debate about the extent of state oversight and the boundaries of personal financial privacy. While the currency's programmable features have not been universally implemented, the ability to trace and, in some cases, restrict specific transactions has drawn international attention and prompted calls for clearer safeguards. Sweden's e-krona project offers a different perspective. In a country where cash use was already low, the e-krona aims to provide a secure, government-backed alternative to private payment platforms. The transition has been largely smooth in urban areas, but technical outages and inconsistent connectivity in rural regions have exposed vulnerabilities in an almost entirely digital payment ecosystem. These challenges have prompted renewed discussions about the importance of backup systems and the risks of excluding those without reliable internet access. Central banks in the United States and the European Union have taken a more cautious approach. Both the Federal Reserve and the European Central Bank continue to explore the implications of digital currencies, focusing on balancing innovation with privacy and financial stability. Pilot programs have tested features like conditional payments and direct accounts with central banks, but widespread rollout remains subject to ongoing debates about anonymity and the potential impact on commercial banks. Privacy advocates warn against systems that create extensive transactional records, while proponents argue that digital currencies could help prevent fraud and misuse of public funds. In India, the digital rupee demonstrates the challenges of scale. Despite a large volume of daily transactions, the overall share of payments conducted via CBDC remains low compared to established platforms. Limited smartphone access, electricity constraints, and regional disparities slow adoption, even as the government promotes offline functionality and financial education. Efficiency gains are clear in certain areas. Real-time settlement of transactions has reduced payment delays for both individuals and businesses. Some governments have used CBDCs to deliver targeted relief more quickly during crises, bypassing traditional banking bottlenecks. Cross-border payments, previously slow and costly, have become faster and cheaper in pilot projects, though regulatory differences between countries continue to present obstacles. Yet these technological advances come with trade-offs. The ability to track every transaction raises questions about surveillance, data protection, and the appropriate limits of state power. Consumer surveys consistently show that many people value the convenience of digital payments, but remain wary of losing the anonymity provided by cash. Technical solutions that promise privacy, such as zero-knowledge proofs, are under development, but have yet to see wide adoption in major currencies. CBDCs also have the potential to alter the role of commercial banks. By allowing individuals to hold digital currency directly with central banks, traditional banks face new competition for deposits. Some have responded by increasing interest rates on fixed-term deposits, but concerns remain about the long-term impact on lending and financial stability. As digital currencies become more common, their influence extends beyond payments. They offer policymakers new ways to target stimulus, monitor economic activity, and enforce regulations. But the debate over privacy, control, and the future of money is far from settled, with more countries moving beyond experimental pilots. The question is no longer whether digital currencies will play a role in the global economy, but how their adoption will reshape the way societies measure and pursue economic progress. Post-GDP economic metrics. As traditional economic measures come under increasing scrutiny, a growing number of countries are experimenting with new ways to define and track national progress. The movement away from GDP as the sole benchmark for prosperity has gained momentum, with 12 nations now maintaining official alternative metrics that attempt to capture well-being, sustainability, and social cohesion alongside economic output. Bhutan's Gross National Happiness Index remains the most recognized early example. Since the 1970s, Bhutan has prioritized happiness over GDP, using a framework that considers psychological wellness, health, education, and environmental diversity. While this approach has brought global attention to the idea of measuring happiness, policymakers still face challenges translating these broad indicators into actionable policies. The lack of detailed economic data within the index sometimes makes it difficult to address specific issues with precision, and debates continue over how best to balance subjective well-being with more concrete economic needs. New Zealand's Living Standards Framework offers a different model, focusing on a set of well-being indicators that influence government budgeting. The framework includes measures such as housing quality, mental health, and environmental sustainability. In recent years, New Zealand has allocated funding with the explicit goal of improving these indicators, shifting the focus from pure economic growth to broader social outcomes. While the approach has led to increased investment in mental health and sustainable infrastructure, critics argue that the process introduces new complexities into the budgeting system and makes it harder to evaluate success using traditional benchmarks. Scotland's National Performance Framework tracks a wide range of outcomes beyond GDP, emphasizing both economic opportunity and social well-being. The data reveal persistent disparities between urban and rural regions, with cities typically scoring higher on economic metrics, while rural areas excel in environmental stewardship. This level of detail allows for more targeted policy interventions, but it also requires substantial administrative resources and ongoing coordination across local authorities. Amsterdam, drawing on the principles of donut economics, now assesses city performance against both social foundations and ecological limits. The city's 2025 report highlights progress in reducing material consumption and promoting circular economy policies. Businesses face taxes based on resource use rather than just profits, creating incentives for sustainable practices. While this model has driven some measurable environmental gains, it also presents new challenges for businesses adapting to different regulatory standards. Canada's quality of life framework demonstrates how larger economies are adapting post-GDP thinking. Statistics Canada publishes quarterly reports based on indicators across prosperity, health, society, environment, and governance. Recent data show that even with strong GDP growth, life satisfaction among young adults has stagnated, prompting new policy discussions around housing affordability and mental health services. Some provinces have begun linking infrastructure funding to improvements in these quality of life measures, signaling a shift in how success is evaluated at the policy level. Implementing alternative metrics is not without complications. Integrating new indicators into national accounts often exposes conflicts with established reporting methods. Countries adopting sustainability or well-being metrics sometimes struggle to reconcile these with traditional economic data, creating confusion among international investors and policymakers. The OECD notes that over 24 distinct well-being frameworks are in use globally, making cross-country comparisons difficult and raising questions about whether a universal set of indicators is feasible or even desirable. Corporate interest in non-financial reporting has grown, with more firms including environmental, social, and governance metrics in public disclosures. However, the financial sector continues to prioritize conventional profit-based measures, and most asset managers still rely heavily on traditional financial statements when making investment decisions. Credit rating agencies also focus primarily on GDP growth and debt ratios, limiting the influence of alternative metrics on sovereign credit assessments. Choosing which metrics to include in national or corporate reports remains a contentious process. Decisions about whether to track biodiversity, inequality, or other social outcomes often reflect political priorities and can provoke pushback from affected groups. The act of selecting indicators forces societies to clarify what they value most, but it also reveals the trade-offs inherent in any attempt to redefine progress. Advances in technology are beginning to shape the measurement landscape. The European Union's experimental use of satellite data and machine learning offers more timely and detailed environmental statistics than traditional surveys. These innovations hold promise for producing more responsive and accurate metrics, but they also raise privacy concerns and require careful oversight. Despite the growing adoption of post-GDP frameworks, the tension between new metrics and established economic structures remains unresolved. While alternative indicators can highlight issues like inequality and sustainability that GDP alone may obscure, they have yet to displace GDP as the dominant reference point for markets and policy decisions. As societies continue to test and refine these frameworks, the question is whether they will ultimately reshape economic priorities or remain supplementary to traditional measures. This ongoing evolution in how progress is measured sets the stage for further challenges, especially as economic systems confront rapid changes in the nature of work and the structure of labor markets. Automation's economic impact. Automation is now a defining force in the global economy, influencing everything from how work is structured to how value is distributed. In 2025, the expansion of artificial intelligence and robotics has altered the labor landscape in ways that traditional economic indicators often fail to capture. Major banks, for example, now rely on AI for a wide range of standard processes, streamlining operations but reducing the need for human staff in many frontline roles. Warehousing, logistics, and routine office work have seen significant declines in employment as automation tools become more capable and affordable, with the speed of change outpacing earlier industrial shifts. While automation has removed certain categories of jobs, it has also created new roles focused on supervising, maintaining, and improving autonomous systems. Positions such as AI system monitors and robot maintenance technicians are now common in industries where they barely existed a decade ago. However, These roles often come with less job security and lower average pay than the positions they replaced. The rapid evolution of technology means that training programs struggle to keep up, and workers frequently find that newly acquired skills become outdated in just a few years. A key trend is the growing mismatch between productivity gains and wage growth. Data from the Federal Reserve and OECD show that while output per worker continues to rise, wages have not kept pace. In the United States, for example, inflation has outstripped wage growth in recent years, with consumer prices rising 3.5%, while average wages grew only 3%. This gap is even more pronounced in sectors most affected by automation, where companies reap the benefits of increased efficiency but pass on only a small share to employees. As a result, the share of national income going to labor has declined, and income inequality has widened, with the top 10% of wealth holders capturing much of the economic gains. The rise of gig and platform work has further complicated the employment picture. Many workers now rely on short-term contracts or app-based jobs, which offer flexibility but few benefits or protections. The Bureau of Labor Statistics Quality Employment Index indicates that a shrinking portion of the workforce enjoys stable hours, benefits, and clear career progression. This shift undermines the traditional social contract between employers and employees, especially as full-time positions with health insurance and retirement plans become less common. Education systems face ongoing challenges in preparing workers for this new reality. Certificate programs and vocational training often lag behind industry needs, and the rapid pace of technological change means that employers increasingly value practical experience over formal credentials. According to recent LinkedIn data, a significant share of new hires in technology roles lack conventional degrees, reflecting the changing requirements of the job market. Policy responses to automation vary by country. Some governments, such as South Korea, have experimented with targeted interventions like robot taxes to fund retraining programs, aiming to slow the pace of job displacement and support workers in transition. In contrast, the United States has largely relied on market forces, resulting in faster adoption of automation but fewer safety nets for those displaced. Norway and other northern European countries have focused on active labor market policies, investing in continuous education and job placement services to help workers adapt. These differences in approach have produced uneven outcomes, both within and between countries. In regions where policy support is strong, displaced workers are more likely to find new employment at similar wage levels. Where support is lacking, workers often cycle through low-wage service jobs or drop out of the labor force altogether. The resulting disparities contribute to social and political tensions, as communities struggle to adjust to the realities of an automated economy. Automation's impact extends beyond employment and wages. Shifts in consumption patterns are emerging as more households rely on income streams tied to digital platforms, algorithmic trading, or content creation. These sources of income can be volatile and unpredictable, exposing families to greater financial risk. At the same time, capital markets increasingly favor companies with lower labor intensity, reinforcing incentives for further automation. Economists and policymakers are still developing frameworks to understand and manage these changes. Forecasting models often underestimate the speed and scale of labor market disruption, leading to policy gaps and delayed responses. Experimental ideas such as universal basic assets or data dividends are being discussed, but have yet to see widespread implementation or proven results. As the economic effects of automation accumulate, the need for new approaches to distribution and risk sharing becomes more urgent. The challenge is not only to ensure that productivity gains benefit a broader segment of society, but also to adapt institutions and policies to a world where traditional employment is no longer the norm for many. This pressure for adaptation is likely to intensify as other forces, particularly environmental and climate-related disruptions, begin to reshape economic priorities and expose new vulnerabilities. The climate change factor. Climate change now plays a direct and visible role in shaping economic realities across sectors and regions. Central banks in major economies have begun to incorporate climate risk into their scenario planning, reflecting a growing recognition that environmental disruptions can impact inflation, credit markets, and long-term growth. The Dallas Fed, for example, has noted that persistent core inflation early in the year is increasingly linked to weather-related supply shocks and seasonal volatility in food and energy prices. Trade policy is also evolving in response to the climate challenge. The European Union's Carbon Border Adjustment Mechanism is in its earliest stages of implementation, serving as a test case for using tariffs to address carbon leakage and incentivize cleaner production methods abroad. While the mechanism's full economic impact remains to be seen, it has already prompted manufacturers and exporters in high-emission sectors to reevaluate their supply chains and consider investments in lower carbon technologies. Insurance markets provide another clear signal of climate's economic influence. As extreme weather events become more frequent and severe, insurance premiums have risen sharply in high-risk areas. State-backed insurers have expanded their role, stepping in where private carriers withdraw or raise prices to unsustainable levels. These changes in risk pricing are beginning to influence migration patterns, business investment decisions, and even access to credit for homeowners and small businesses. Corporate reporting standards have shifted in response to investor demand for transparency around climate-related risks. Since 2024, publicly listed firms are required to disclose their exposure to climate risks based on guidelines from the International Sustainability Standards Board. Early disclosures reveal that some companies face substantial stranded asset risks, particularly in sectors linked to fossil fuels and resource extraction. Investors increasingly treat these risks as material to long-term financial performance, integrating them into portfolio decisions and shareholder advocacy. Labor markets are not immune to these pressures. Heat waves, wildfires, and floods disrupt work schedules and reduce productivity in affected regions. Manufacturing and construction projects experience more frequent delays, and employers in vulnerable sectors are forced to adjust wage and staffing forecasts. The Dallas Fed's analysis suggests that these disruptions add a layer of unpredictability to inflation, complicating the work of policymakers and business planners alike. Food systems illustrate the uneven effects of climate change on economic stability. Crop yields fluctuate as droughts, floods, and heat waves alter growing seasons and reduce output in some areas while expanding opportunities in others. For example, some northern regions are now seeing higher yields for certain crops, while traditional agricultural centers face mounting losses. The resulting shifts in supply contribute to inflation volatility, with Statista reporting that consumer prices rose by 3.5% by March 2024, in part due to food and energy costs. The transition to renewable energy continues, shaped by both policy and market forces. Falling costs for solar and wind generation are accelerating the retirement of older, less efficient fossil fuel plants. However, supply chain constraints for critical minerals and uncertainty over future demand have complicated investment decisions. The BEA and Atlanta Fed both note that these factors introduce a new dimension of uncertainty into GDP and productivity forecasts, as energy markets adjust to changing technology and regulatory environments. Financial regulators now view climate risk as a systemic issue, not just a sector-specific concern. Uncertainty in forecasting the economic impacts of climate events has led to calls for more conservative assumptions in stress testing and capital requirements. The Congressional Budget Office has highlighted the difficulty in projecting the full scope of climate-related disruptions, especially as interconnected risks, such as simultaneous crop failures and energy price spikes, become more plausible. Market-based solutions for decarbonization, such as carbon trading and green bonds, have expanded but remain the subject of skepticism. While carbon markets have grown in volume, questions persist about their effectiveness in actually reducing emissions, and voluntary offset programs face ongoing credibility challenges. Regulatory attempts to define sustainable investment standards continue, but inconsistencies persist across jurisdictions and asset classes. These developments underscore the complex and often unpredictable ways climate change interacts with economic systems. The limits of traditional market mechanisms are increasingly apparent, and the search for more reliable approaches to managing climate risk continues. As policymakers and investors grapple with these realities, new experiments in economic design are gaining attention, some of which propose alternative models for value and exchange that aim to sidestep the limitations of existing systems. Cryptocurrencies have moved from the fringes of finance to a prominent, if controversial, position in the global economic conversation. Nowhere is this more evident than in El Salvador, where the government made Bitcoin legal tender in 2021. The policy was intended to attract investment, improve financial inclusion, and reduce remittance costs. But its implementation over the past 4 years has revealed both the potential and the limits of digital currency as a foundation for national economies. Initial optimism about Bitcoin's promise quickly encountered practical challenges. While many Salvadorans experimented with Bitcoin, central bank surveys indicate that only a small fraction of daily transactions now involve cryptocurrency. Most businesses, particularly larger ones, comply with the law by accepting Bitcoin but immediately convert it to US dollars to avoid exposure to price volatility. For small retailers and rural merchants, technical infrastructure remains a barrier. Unreliable internet access, unpredictable transaction fees, and frequent outages in the government's digital wallet system complicate everyday use. These obstacles have led many to prefer cash or traditional digital payments, despite the legal requirement to accept Bitcoin. Remittances, which play a major role in El Salvador's economy, were a central justification for adopting Bitcoin. The government hoped that cryptocurrency transfers would offer a cheaper, faster alternative to established money transfer services. In practice, however, volatility in Bitcoin's price has made it difficult for families to predict the value of transferred funds from week to week. Most remittance flows continue to use conventional wire services, with only a modest share routed through Bitcoin channels. The unpredictability of exchange rates and network fees has limited the appeal of cryptocurrency for those who depend on stable, predictable income. The anticipated economic benefits have not materialized as projected. While a handful of cryptocurrency entrepreneurs relocated to El Salvador and some tourism activity was linked to Bitcoin's novelty, these effects were not sufficient to offset declining investment from more traditional sources during a prolonged downturn in global crypto markets. The government's own Bitcoin holdings, acquired at prices well above current market levels, remain underwater. Authorities have not disclosed the full impact on public finances, but the value of these assets has fluctuated widely, raising concerns about fiscal stability and transparency. El Salvador's experience has also highlighted the reluctance of the banking sector to fully embrace cryptocurrency. Although required to offer Bitcoin services, banks have generally made the process slow and cumbersome, reflecting skepticism about the stability of crypto-based income and the risks of regulatory uncertainty. For customers, converting Bitcoin to dollars can take days, and loan applications that disclose crypto earnings often face higher interest rates. International accounting standards have yet to provide clear guidance on how to classify or value cryptocurrency holdings, compounding the challenge for financial institutions. International observers have watched El Salvador's experiment closely, but few have followed its lead. Other countries considering similar policies have hesitated, citing the technical, economic, and social hurdles revealed by El Salvador's experience. The volatility of cryptocurrencies and the complexity of integrating them into existing financial systems have proven difficult to manage, especially in economies where infrastructure and regulatory capacity are limited. The broader pattern of cryptocurrency adoption in developed economies shows a shift away from retail transactions and towards speculative investment. Institutional investors now dominate trading volumes, treating cryptocurrencies primarily as volatile assets rather than as practical alternatives to national currencies. Surveys indicate that everyday use of cryptocurrencies for purchases has declined, with most people citing regulatory uncertainty and price swings as major deterrents. Underlying all these developments is a fundamental tension. Decentralized digital currencies offer new possibilities for value transfer and financial autonomy, but they also introduce risks that traditional monetary systems are designed to minimize. Price stability, regulatory oversight, and integration with existing institutions remain unresolved challenges. El Salvador's experiment demonstrates that while cryptocurrencies can supplement conventional financial tools, they have yet to prove themselves as reliable foundations for national economies. As the world continues to test new models for money and value, the outcomes of these experiments will shape the broader economic landscape. The next major shift will not come from technology alone, but from the changing hands of wealth and the evolving priorities of those who control it. Generational wealth transfer. A profound shift is unfolding as inherited assets move from older to younger generations, shaping not only individual financial outcomes, but also broader economic patterns. This generational wealth transfer is occurring at a time when the financial realities facing recipients differ sharply from those of previous decades. Millennials, now the primary inheritors, encounter a landscape defined by high housing costs, persistent student debt, and the prevalence of gig and contract work rather than stable, long-term employment. These factors influence how newly acquired wealth is managed and deployed. One of the most notable changes in this transfer is the age at which inheritances are received. Unlike previous generations who typically inherited in their 50s or 60s, many millennials are accessing inherited wealth in their 30s or even earlier. This earlier timing intersects with life stages that often involve starting families, buying homes, or paying off educational loans. As a result, the immediate use of inherited assets tends to focus on debt reduction rather than traditional investment. Surveys and background research suggest that millennials are more likely to prioritize paying down student loans and mortgages, reflecting the financial pressures unique to their cohort. This behavior stands in contrast to older recipients, who often directed inherited funds toward expanding investment portfolios or retirement savings. Investment preferences also show a marked generational divide. While older generations have typically favored established financial instruments like stocks and bonds, millennials display a stronger interest in alternative assets and socially responsible investment vehicles. Environmental, social, and governance (ESG) funds, as well as digital assets, attract a larger share of millennial portfolios than they did for previous generations at similar life stages. This shift is partly a response to changing values, but it also reflects a desire for investments that align with broader social and environmental goals. Asset managers and financial institutions have responded by offering new products tailored to these preferences, although it remains uncertain whether these trends will endure as recipients age and their financial priorities evolve. Housing markets are directly affected by this wave of inheritance. Many younger recipients use inherited funds to enter urban property markets, contributing to increased demand and rising prices in major cities. While this enables some to overcome long-standing barriers to homeownership, it also intensifies competition and can push non-inheritors further out of reach. The concentration of inherited wealth in certain regions, especially urban centers with decades of property appreciation, reinforces geographic disparities and shapes migration patterns. The experience of receiving a significant inheritance can be challenging for those without prior exposure to wealth management. Financial advisors report that many young inheritors initially make impulsive decisions or adopt overly cautious strategies, keeping assets in low-yield accounts due to uncertainty about market conditions. This has driven demand for financial literacy programs focused on inheritance management, though gaps in knowledge persist. Taxation and policy responses have not always kept pace with the changing dynamics of wealth transfer. Inheritance taxes and estate planning rules vary widely, and existing frameworks often struggle to address the complexities of modern family structures and asset types. Policy debates continue over how best to structure taxation to balance fairness, economic mobility, and revenue needs without discouraging productive investment. The broader economic impact of this generational wealth shift is still taking shape. Some analysts have speculated that large inheritances could reduce labor force participation, but current evidence indicates that most recipients continue working, with some using newfound financial flexibility to change careers or reduce hours rather than exit the workforce entirely. Meanwhile, the influx of inherited capital into housing, investment, and consumption patterns is already visible in market data. What remains clear is that the transfer of wealth across generations is not occurring in isolation. It interacts with other powerful trends, rising automation, evolving labor markets, and shifting social priorities, to create a landscape where the outcomes are difficult to predict. As these forces converge, they are reshaping economic expectations and prompting ongoing experimentation with new models of work, wealth, and opportunity. The 4-day work week. Among the workplace innovations under discussion in 2025, the 4-day work week has received considerable attention as both employers and employees seek to balance productivity with quality of life. The idea of reducing the standard workweek has circulated for decades, but recent years have seen a surge in interest, with a variety of organizations and governments exploring its feasibility. While headlines often focus on the promise of improved well-being and greater efficiency, the practical realities of adopting a shorter workweek remain complex and context-dependent. Most available research suggests that the impact of a 4-day work week varies widely by sector and national context. In some industries, particularly those reliant on knowledge work or project-based output, condensed schedules are easier to implement. These sectors can often reorganize tasks and use digital tools to maintain productivity, even as total working hours decrease. In contrast, service industries and roles requiring constant coverage, such as healthcare, retail, and logistics, face greater challenges. Maintaining the same level of service with fewer staff hours can lead to operational strain, uneven workloads, and in some cases, reduced customer satisfaction. One of the recurring themes in the discussion around shorter workweeks is the need for careful planning and adaptation. Companies that have experimented with reduced schedules often invest significant resources in workflow redesign, communication protocols, and employee training before making the transition. These upfront costs can be substantial, and outcomes are not always predictable. For small businesses lacking the capacity for large-scale changes, the transition may prove especially difficult. The experience of firms across different countries highlights that a one-size-fits-all solution rarely succeeds. Instead, the success of a 4-day workweek depends on tailoring the approach to the specific needs of each organization and industry. Economic research has yet to reach a consensus on the broader implications of widespread adoption. While some early studies report improvements in employee morale, reduced absenteeism, and modest gains in productivity, these results are not universal. In many cases, shifts in work schedules have produced only marginal changes in output, and some organizations have reverted to traditional models after initial trials. The complexity of measuring productivity, especially in service and creative sectors, makes it difficult to draw clear conclusions about the long-term effects of a condensed workweek. Another factor complicating the analysis is the role of seasonal and cyclical economic patterns. The Dallas Fed's recent work on inflation dynamics, for example, suggests that early-year inflation spikes are often tied to seasonal factors rather than changes in work schedules or labor market structure. This finding highlights the challenge of isolating the effects of a 4-day workweek from broader economic trends. Policymakers and business leaders must consider these external influences when evaluating the potential benefits or drawbacks of reducing standard work hours. The question of wage adjustments remains unresolved. In most trials, salaries have been maintained despite reduced hours, raising concerns about long-term sustainability and potential inflationary pressures if adopted at scale. Labor negotiations in some countries have produced compromises, such as higher hourly wages to offset fewer weekly hours. But these solutions are not easily replicated across all sectors. The risk of widening wage disparities and the potential for increased labor costs remain central concerns for both employers and policymakers. Public response to the idea of a 4-day workweek is generally positive, with surveys indicating strong interest among workers in a better work-life balance. However, the transition often requires changes in consumer behavior and expectations. For example, businesses that close midweek or adjust service hours can face initial confusion or resistance from customers. Over time, these adjustments may become normalized, but the process can be uneven and pose challenges for organizations that rely on established routines. Ultimately, the 4-day workweek represents a promising but complicated innovation. Its success depends on a range of factors, from sector-specific labor requirements to broader economic conditions. As organizations continue to experiment with different models, the evidence points to gradual, uneven adoption rather than a sweeping transformation of labor markets. The lessons learned from these trials will inform future debates about how best to structure work in a changing economic landscape. Changes in work schedules are only one aspect of the evolving economic environment. Broader shifts in work and consumption patterns, many of which began during the pandemic years, continue to influence how economies function and adapt. Post-pandemic economic shifts. In the years following the pandemic, economic systems have absorbed a series of persistent changes that continue to shape daily life and long-term planning. The initial disruptions to work, consumption, and urban infrastructure did not simply fade with the return of public health stability. Instead, they set in motion adjustments that are still unfolding, often in ways that complicate established economic models. One of the most visible shifts has been in the use and value of commercial real estate. While many anticipated a swift rebound in office demand, large urban centers still contend with significant oversupply. The drop in demand for downtown office space has led to declining property values and, in some cities, shrinking tax revenues. Municipal budgets have come under pressure, forcing local governments to reconsider spending priorities and the viability of public services that once relied heavily on commercial property taxes. Some developers have attempted to convert office buildings to residential use, but technical and financial obstacles limit how much of this vacant space can be repurposed. The result is a patchwork of partial solutions, with cities experimenting to find new roles for underutilized infrastructure. The workplace itself has undergone a transformation that continues to influence labor markets and urban economies. Remote and hybrid work arrangements, which expanded rapidly during the pandemic, have not reverted to pre-crisis norms. Instead, many organizations now operate with a mix of in-person and remote staff, creating new patterns of demand for office space, transportation, and local services. This shift has contributed to the uneven recovery of urban transit systems, as ridership remains below pre-pandemic peaks. Transit agencies face financial strain as they adjust to flatter usage patterns and the need to maintain large, complex networks with reduced fare revenue. Residential real estate markets have also realigned in response to changing work habits. As proximity to city centers becomes less important for many workers, demand has shifted toward suburban and exurban areas. Homebuyers increasingly prioritize features like dedicated office space and reliable internet access over short commutes. This has led to new patterns of housing demand, with some regions experiencing price surges while others see stagnation or decline. The uneven nature of this adjustment has implications for local economies, school funding, and infrastructure planning. The retail sector has faced its own set of challenges. While e-commerce experienced a surge during the pandemic, traditional brick-and-mortar stores have adapted by emphasizing in-person experiences and convenience. Retailers have redesigned store layouts, focusing on demonstration areas and services that cannot be replicated online. Some chains have reduced their physical footprint, while others have closed unprofitable locations altogether. These changes have affected employment in retail, with shifts toward roles that emphasize customer engagement and logistics. Supply chains, previously optimized for efficiency and scale, have been reconfigured to prioritize resilience and flexibility. Companies have invested in regional distribution centers and diversified their supplier networks to reduce exposure to global disruptions. This reorganization has required significant capital investment and ongoing adaptation as consumer preferences and logistical challenges evolve. Inflation dynamics have also shifted in the post-pandemic period, challenging the assumptions of policymakers and analysts. The Dallas Fed has highlighted recurring errors in monthly inflation measurement, particularly early in the year, as seasonal patterns interact with lingering supply and demand imbalances. Early year surges in core consumer prices have complicated efforts to interpret underlying economic trends, raising questions about the adequacy of traditional inflation models in a changed environment. Corporate travel and hospitality have settled into new patterns, with business travel volumes remaining well below pre-pandemic levels. Companies continue to rely on video conferencing and digital collaboration tools, reducing the need for routine travel and reshaping demand for hotels and airlines. This adjustment has prompted the hospitality industry to focus more on leisure travelers and weekend occupancy, while also experimenting with new service models. Labor markets reflect the cumulative impact of these changes. Job postings that offer remote or flexible work arrangements attract more applicants, and companies that insist on full-time office attendance often face higher turnover. Wage premiums have emerged for roles that allow location flexibility, especially in competitive industries. These developments highlight a shift in bargaining power toward workers with in-demand skills, while also exposing gaps in traditional employment protections. Policymakers continue to grapple with the broader implications of these shifts. Questions remain about how to support urban transit, manage commercial real estate risks, and ensure equitable access to housing and employment opportunities. The incremental nature of these adjustments stands in contrast to the dramatic changes that some observers predicted. Instead, the post-pandemic economy is marked by a series of overlapping adaptations, each shaped by the constraints of physical infrastructure, institutional inertia, and evolving social preferences. As cities and economies search for new models to address persistent challenges, the question of how to provide affordable, stable housing has come to the forefront. The next section examines one approach that has attracted international attention as a possible solution to the growing pressures of urban living: the housing crisis solution. Vienna's approach to public housing has attracted considerable attention from urban planners and policymakers seeking practical solutions to rising housing costs. While the specifics of Vienna's model are often debated, its core principles stand out: a long-standing commitment to municipal involvement, a mix of public and limited profit development, and an emphasis on social integration rather than simply providing shelter for the lowest income residents. The city system is rooted in the idea that housing should be treated as essential infrastructure, not just a commodity for speculation. Municipal authorities have historically purchased land for public use, which allows them to remove the speculative component from housing costs. This approach stabilizes prices and ensures that new construction can prioritize long-term affordability over short-term profit. Financing typically combines municipal investment, national subsidies, and tenant contributions, with the goal of keeping rents predictable and maintenance standards high. Residents often gain a financial stake through refundable deposits, which encourages a sense of responsibility and community stability. Private sector involvement is tightly regulated. Limited profit housing associations play a significant role, operating under strict rules that cap returns and require reinvestment into existing or new housing stock. These organizations benefit from preferential access to city-owned land and tax incentives, but they must adhere to affordability and quality standards. The result is a diverse housing landscape that avoids the pitfalls of both purely public and entirely market-driven systems. Social housing is distributed throughout the city, and eligibility criteria are structured to avoid concentrating poverty in specific neighborhoods. This integration helps maintain a broad social mix and supports social cohesion. Quality and livability are central to the model. New developments include communal spaces, childcare facilities, and amenities designed to support daily life. The goal is not only to provide shelter, but to create environments where residents can build stable lives. Maintenance and renovation are prioritized, with regular upgrades ensuring that public housing remains attractive and functional. High standards help counteract the negative perceptions that often surround public housing in other contexts. International comparisons highlight the strengths and limitations of Vienna's approach. The city's focus on long-term planning and public investment has contributed to lower levels of homelessness and more stable housing costs than many peer cities. However, attempts to replicate the model elsewhere often encounter challenges. Cities without a tradition of municipal land ownership or with fragmented political leadership struggle to match Vienna's scale and consistency. Some efforts, such as those in Amsterdam or Barcelona, have run into legal and financial barriers that limit their impact. Even within Austria, smaller cities sometimes find it difficult to maintain quality and affordability at the same level. Critics of the Vienna model point out that it benefits from unique historical and cultural conditions. The city's early and sustained investment in public land, combined with a political consensus around housing as a public good, is not easily reproduced elsewhere. Additionally, the system requires ongoing funding and administrative capacity, which may be beyond the reach of municipalities facing fiscal constraints or volatile governance. Despite these challenges, the evidence suggests that direct public involvement in housing can yield measurable benefits. Studies from the Austrian Central Bank and other research institutions find that residents in public or limited-profit housing tend to have higher disposable incomes, better health outcomes, and greater workforce mobility than those renting at market rates. The stability provided by affordable housing supports educational attainment and reduces reliance on social services, creating a broader base for economic participation. While no single model can resolve the housing crisis in every context, Vienna's experience demonstrates that policy choices matter. Cities that treat housing as infrastructure, invest in long-term affordability, and prioritize integration over segregation are better positioned to manage urban growth and maintain living standards. As debates over housing policy continue, the lessons from Vienna offer a reference point for what is possible when public purpose guides development. The question of how to ensure broad access to foundational resources is not limited to housing. Other areas of social policy, including education, have begun to show similarly far-reaching economic role on economic mobility. Education policy remains a central factor in shaping economic outcomes, influencing how societies adapt to changing labor markets and technological disruptions. As governments reassess the value of higher education, recent years have seen a renewed debate over the economic impact of tuition-free systems and the broader role of public investment in knowledge and skills. Among the best documented examples is Finland's long-running commitment to free higher education. Since abolishing tuition fees, Finland has prioritized broad access to university and vocational training, with the aim of equipping its workforce for rapid technological change. Policymakers point to the country's ability to retrain workers for emerging fields, particularly in response to automation and artificial intelligence. Early evidence suggests that these policies support higher labor force participation rates and smoother transitions between sectors, although the long-term effects on innovation and productivity are still being analyzed. The Finnish model emphasizes the idea that education should function as a form of economic infrastructure, supporting not just individual advancement, but wider adaptability and resilience. Elsewhere, the debate over education funding often centers on the trade-offs between access, quality, and fiscal constraints. While some countries experiment with tuition-free models, others maintain or even increase user fees, citing budgetary pressures and concerns about efficiency. Critics of free education argue that such policies may strain public finances, particularly in larger or more diverse economies. However, proponents point to the potential for broader social benefits, including higher social mobility, reduced inequality, and a more dynamic labor market, when barriers to education are minimized. In the United States, the consequences of rising education costs are increasingly visible in broader economic dynamics. The Federal Reserve has highlighted how high student debt burdens can delay home ownership, reduce small business formation, and alter consumer spending patterns. These effects ripple through the economy, shaping demand for goods and services and influencing overall growth. At the same time, the persistence of education-related debt has prompted renewed calls for policy reform, with some states exploring targeted tuition relief or expanded access to vocational training as alternatives to traditional university pathways. Recent research also underscores the importance of aligning education systems with labor market needs. Countries that regularly update curricula and invest in adult retraining are better positioned to respond to shifts in technology and industry demand. Finland, for instance, has implemented government-backed programs to retrain workers for AI-related roles, with a notable share of the workforce participating in these initiatives. By contrast, systems that rely heavily on private financing or lack coordinated retraining efforts often struggle to adapt, leaving workers vulnerable to job displacement and wage stagnation. The broader economic literature suggests that investment in education yields returns that extend well beyond individual earnings. Studies of Scandinavian countries, for example, estimate that each dollar spent on higher education can generate several times that amount in long-term economic growth, driven by innovation, higher productivity, and greater workforce flexibility. These findings challenge traditional views of education as a purely personal investment and support the argument for treating education as a public good. Still, implementation challenges remain. Expanding access without addressing quality or labor market alignment can lead to mismatches between graduate skills and available jobs. Some countries have encountered capacity constraints or uneven outcomes when rolling out tuition-free policies, highlighting the need for careful planning and ongoing evaluation. Policymakers must balance the goals of equity, efficiency, and fiscal sustainability while ensuring that education systems remain responsive to changing economic conditions. The conversation around education's economic role increasingly intersects with other policy domains, from housing and health to environmental sustainability. As societies grapple with the demands of technological change and demographic shifts, the ability to equip people with relevant knowledge and skills becomes a key determinant of economic resilience. The challenge is not only to expand access, but to ensure that education systems support broader societal goals and can adapt to new realities. This emphasis on adaptability and resource management is also reshaping how countries approach other foundational systems. New models are emerging that treat waste and resource use as integral parts of economic planning, reflecting a shift toward more circular and sustainable forms of growth. The circular economy. Over the past decade, the circular economy has gained traction as an alternative to the traditional linear model of take, make, dispose. This approach seeks to extend the life cycle of materials through reuse, repair, remanufacturing, and recycling, aiming to reduce waste and minimize resource extraction. While the concept is widely promoted by policymakers and industry leaders, real-world progress remains uneven, with notable differences between countries, sectors, and even cities. Some nations have made visible headway by integrating circular principles into their waste management and manufacturing systems. For example, several European countries have introduced extended producer responsibility programs, requiring companies to manage the collection and recycling of their products at end of life. These initiatives have encouraged manufacturers to redesign products for easier disassembly and material recovery. In certain regions, deposit return schemes for bottles and packaging have achieved high collection rates, creating a reliable stream of secondary materials for industry. However, these successes are often concentrated in wealthier, densely populated areas with established infrastructure and strong regulatory oversight. Elsewhere, the transition has proven more difficult. Many developing countries face significant barriers in building the sorting and processing infrastructure needed for effective recycling. Informal waste collection remains widespread, and attempts to formalize these systems can meet resistance from existing workers who depend on the current structure for their livelihoods. Even where new facilities are built, participation rates can plateau without sustained public engagement and incentives. Statista reports that global recycling rates have improved modestly in recent years, but major gaps persist between high-income and lower-income countries. Business models are also evolving in response to circular economy principles. Some companies now lease products rather than selling them outright, maintaining ownership of materials and ensuring their recovery at end of life. This product-as-a-service model is most common in sectors like electronics and lighting, where firms can refurbish or recycle components to reduce material costs. While early results suggest profitability and resource savings, these approaches require significant changes to logistics and customer relationships. Not all industries have found it practical to adopt circular models at scale, particularly those with complex supply chains or products that are difficult to disassemble. Economic data from cities experimenting with circular policies show mixed results. Some urban areas have reported growth in circular businesses and reductions in the use of virgin materials. These changes have supported local job creation, particularly in repair, refurbishment, and recycling sectors. However, labor market impacts are not universally positive. Sorting and recycling jobs can be hazardous and often pay less than traditional manufacturing roles. Retraining workers for new positions in repair or remanufacturing remains a challenge, especially where educational and vocational systems are slow to adapt. Material markets introduce further complications. Prices for recycled commodities such as plastics, metals, and paper often fluctuate significantly, making long-term investment in recycling infrastructure risky. When the price of virgin materials drops, demand for recycled inputs can fall, undermining the economic case for circular systems. Policy tools like carbon pricing and digital product passports have been introduced in some regions to improve the competitiveness of recycled materials and track them through supply chains. But results are still emerging. Measurement and accounting frameworks present another set of obstacles. Standard economic indicators like GDP do not fully capture the benefits of waste prevention or resource efficiency. As a result, circular activities may appear less valuable in national accounts compared to traditional extraction and manufacturing. Some countries have begun developing alternative metrics that track material footprints or resource productivity alongside conventional measures, but these efforts are still in early stages. Consumer behavior plays a crucial role in the success of circular initiatives. In places where waste sorting and recycling have become routine, often due to years of public education and enforcement, participation rates are higher and material recovery is more efficient. However, cultural differences and varying levels of infrastructure mean that widespread adoption is far from guaranteed. Efforts to encourage repair and reuse have seen some success, but often require sustained incentives and shifts in consumer expectations. Despite these challenges, the circular economy continues to attract interest as a potential strategy for decoupling economic growth from resource consumption. While current achievements are promising, they remain concentrated in specific sectors and regions. The broader question is whether these models can scale to address global resource constraints and environmental pressures. As these experiments unfold, they are beginning to influence how economies around the world approach development and convergence. The next section explores how shifts in economic models and new policy approaches are affecting the pace at which developing nations are catching up with advanced economies. Global economic convergence. Emerging economies are now growing at a pace that stands out in recent history, with many countries posting higher growth rates than advanced economies and narrowing some of the most persistent gaps in income and industrial capacity. This acceleration is visible in a range of indicators, from GDP growth to human capital development and export diversification. While the precise numbers and timelines vary, the general trend is clear. The economic distance between what were once labeled developed and developing nations is shrinking faster than conventional growth models anticipated. Several factors drive this faster convergence. Demographic trends in many emerging economies, including larger working-age populations and expanding urban centers, create a foundation for sustained growth. Investment in education and skills training, often supported by targeted government policy, has enabled more people to participate in higher-value industries. Improvements in infrastructure, such as expanded access to electricity, transportation networks, and digital connectivity, have reduced barriers to productivity and allowed businesses to scale more quickly. Technological adoption plays a critical role. Mobile banking and digital ID systems, for example, have expanded financial inclusion in places where traditional banking infrastructure remains limited. These tools help governments deliver benefits more efficiently and support the growth of small and medium-sized enterprises. In manufacturing, automation and robotics are increasingly accessible beyond high-income countries, allowing firms to compete in global value chains and move into more sophisticated production. As a result, exports from emerging economies now include a greater share of electronics, machinery, and high-tech goods, rather than relying solely on raw materials or low-value assembly. Trade relationships have also evolved. Emerging economies are more integrated into global supply chains, both as producers and consumers. They have diversified export profiles, moving beyond commodities to include processed foods, chemicals, and advanced components. This diversification makes economies more resilient to external shocks and creates new opportunities for growth. At the same time, regional trade agreements and new financial arrangements, such as local currency settlements, reduce dependence on traditional hubs and major reserve currencies. Financial markets reflect these changes. There is a growing appetite for local currency bonds and infrastructure financing within emerging markets, and international investors are increasingly willing to hold assets denominated in a wider range of currencies. Improvements in monetary and fiscal management have contributed to greater macroeconomic stability, although challenges remain, particularly in countries facing external debt pressures or volatile capital flows. Institutional reforms have supported economic development by streamlining business regulation, strengthening legal systems, and improving public administration. These changes help attract investment, foster entrepreneurship, and promote more efficient allocation of resources. While progress is uneven and some countries continue to struggle with governance challenges, the overall trajectory points toward stronger, more capable states. Despite these advances, convergence is not uniform. Some countries continue to face significant obstacles, including political instability, high debt burdens, and exposure to climate risks. Regional disparities persist, and not all segments of the population benefit equally from growth. However, the broad pattern of faster convergence challenges older assumptions about static global hierarchies and highlights the increasing diversity of development pathways. This changing landscape has important implications for the structure of the global economy. As emerging economies gain weight, traditional categories and models become less effective at explaining outcomes or guiding policy. The rise of new economic centers, shifting trade patterns, and evolving governance structures suggest that future economic systems will look different from those of the past. Understanding these dynamics is crucial as we consider what comes next. The evolution of economic systems will not follow a single path, but will instead reflect a mix of inherited practices, local innovations, and responses to new challenges. This sets the stage for examining how economies might adapt in the years ahead, blending elements from multiple models to address emerging needs and opportunities. The future of economic systems. Looking at the range of economic experiments underway in 2025, it's clear that no single system offers a universal solution. Instead, countries are drawing on a mix of ideas, sometimes blending market incentives with public investment, sometimes layering new technologies onto older frameworks, and often adapting policies to fit their unique social and institutional contexts. The evidence so far points to hybrid models as the most promising path forward, but each approach brings its own set of trade-offs and uncertainties. Recent policy trials highlight that adaptability matters more than strict adherence to any ideology. Some governments have expanded public roles in housing or healthcare, while others have focused on deregulation and private sector innovation. In practice, the most successful outcomes tend to come from systems that are able to adjust to changing circumstances, whether that means responding to technological advances, shifting demographics, or new environmental pressures. For example, countries with flexible labor markets and robust safety nets have managed workforce transitions more smoothly as automation displaces certain jobs. Meanwhile, those investing in education and retraining see better results in preparing workers for emerging industries. Technological change is accelerating these shifts. Artificial intelligence and digital tools are being used to improve everything from tax collection to public transit planning. While these technologies can increase efficiency and help target resources, they also raise new questions about privacy, equity, and the limits of algorithmic decision-making. Most governments are still figuring out how to strike a balance, using technology to support decision-makers without relying on it as a replacement for human judgment. Efforts to measure economic performance are also evolving. Standard metrics like GDP are increasingly seen as inadequate for capturing well-being or sustainability. Some countries have begun to use dashboards that include indicators for health, education, environmental quality, and social cohesion. These alternative measures do not replace traditional economic statistics, but they offer a broader view of progress and highlight areas that need attention. The challenge is to integrate these new metrics into policy in a way that leads to real improvements, rather than simply adding complexity. Environmental concerns now play a larger role in economic planning. As climate risks become more apparent, many countries are introducing policies that account for environmental impacts alongside financial outcomes. This includes new regulations, carbon pricing, and requirements for companies to disclose their exposure to climate-related risks. These changes are not uniform, and progress varies by country and industry, but the trend is toward greater integration of environmental factors in economic decision-making. Financial systems are also adapting, with central banks testing digital currencies and new forms of regulation. While digital money offers new tools for managing monetary policy and inclusion, it also brings risks related to security, privacy, and the stability of banking systems. Most experiments so far suggest that these technologies will supplement rather than replace existing financial structures, at least in the near term. Cultural factors remain important. Economic systems that work well in one country may not translate directly to another, given differences in social norms, legal traditions, and public expectations. The experience of the past decade shows that attempts to transplant models wholesale often run into resistance or unintended consequences. Instead, the most effective reforms tend to build on local strengths, gradually incorporating new ideas and adapting them as needed. Ultimately, the future of economic systems seems to rest on continuous experimentation and incremental change rather than sweeping transformations. The willingness to learn from both successes and failures, to adjust policies in response to new evidence, and to balance competing priorities is what allows economies to remain resilient. This process of trial and adjustment is not new, but in a world facing rapid technological and environmental shifts, it has become more important than ever. With these realities in mind, the search for better systems remains an ongoing effort. Each experiment, whether in policy, technology, or measurement, offers lessons that shape what comes next. As we reach the end of this analysis, the record from 2025 is clear. Focused economic experiments across a range of models have produced valuable lessons, but But no single approach has solved every challenge. Countries testing alternatives, from new ways of measuring progress to targeted labor and housing reforms, have demonstrated both strengths and shortcomings. These pilot programs, whether in happiness-based metrics or public housing, show that adaptation and context matter as much as the model itself. Continued experimentation remains essential. The most promising results come not from wholesale adoption of any one system, but from incremental adjustments based on evidence from real-world trials. This ongoing process of testing, learning, and refining is what drives meaningful economic progress.